A very warm welcome and welcome to HYCM's workshop with myself, Giles Coghlan. Very good to have you here today. Very warm welcome if this is your first time you'd come into the workshop. It's an important day today, and there will be potential opportunities to look at for the ISM print that we have coming out of the US. So it's probably the top tradable opportunity of the week, that or the non-farm payrolls. So I'm going to be running through what to look for. I also want to remind folks of the key trading concept. Don't forget that as I talk about different entries, exits, the whole idea of these trading workshops is that you can see how a professional trader goes about looking at financial markets. And remember the core principle we're looking at. We want to trade strength against weakness when we're trading. Just like we'd expect this stronger arm to beat the weaker arm, we want to find a stronger currency to pair it with a weaker currency. Now, that can be true on a longer time frame over days and weeks, but it also can be true on a shorter time frame over hours and a day. So I'm going to demonstrate to you how this works in principle today, and just give you an example of how to trade strong currency against a weak currency. And then we'll be looking at the trading the US ISM data. So we've got, some really good topics to look at. And I really look forward to this section and making it clear. If you've just joined the webinar, what we're going to be doing today is looking at some specific opportunities of trading strength against weakness for today, as well as looking at a potential opportunity that's coming up. It's not necessarily a trade, but it could be. Okay, so first of all, let's just look at the calendar. Now, we can see here we've had some key PMI data prints out for both the Eurozone and the UK. Now, if you notice, the Eurozone prints have been above market's maximum expectations. So these prints have been higher than previous market expectations. And higher than the previous forecast. So all of that has given a slight expectation of a little bit of euro strength. Now, remember, we're not expecting medium term the picture to be bullish for the euro, because medium term growth is slowing. We're looking at a potential war footing with Russia and Ukraine going on Europe's doorstep. And we've had a whole string of negative data out of Europe. But for today only, for just the next few hours, there's a bit of positive sentiment for the euro. Similarly, the UK has seen a disappointing PMI print. You see, it's come in below minimum market expectations. So UK economy is a service-driven economy. So with it moving lower, below 53.3 and below 52.8 on the forecast, this is telling us that it's not only below the forecast, but below the minimum expectations, you see? So that's even worse than just below the forecast. It's below minimum forecast, and it's down from the prior. It's showing us that PMI prints are moving lower. Now, tomorrow we have the Bank of England meeting, and expectations are for 100% chance of a 25 basis point hike and a 96% chance of a 50 basis point hike. So expectations are that tomorrow the Bank of England will hike by 50 basis points, but how much they hike by or not is not going to be the issue. The issue is what are they going to say about growth? Do they bring forward their projections for the UK to fall into a recession? Previously, they projected that the UK would fall into recession in 2023. What happens if they meet tomorrow and say, actually, we now think that the UK will fall into recession in the fourth quarter of 2022? You see, so this pound negative data fits with the narrative that we expect the Bank of England to potentially be more dovish. Remember, the Fed met last week. They've gone to a data-dependent meeting by meeting basis, so that was more dovish. Then we had the RBA take their more dovish tilt as they follow the Federal Reserve on a meeting by meeting basis. So what will happen now with the Bank of England? Will they take a more dovish tilt? So all in all, you can see actually that's euro potential strength against pound weakness for today's session. So this is a trade that I've taken. I'm not saying you should take this trade, but I'm just outlining the reasons, the rationale for it. And if you just look here, I'll show you what to look at. Oh, here we go. I'll show you how I've entered and how I've used daily pivot points just to manage and define that risk. So here I have, we've got price around that pivot point. So I've entered at market, and I've just got my stops running the other side of that 8,300 region, and I'm looking for a pop higher, potentially to run higher into the Bank of England meeting tomorrow. Okay, so that's what I'm potentially looking for. I'm potentially looking for this to run higher into tomorrow's meeting. Now, of course, I can be wrong, so I can manage my risk, but it just means on balance, euro pound upside does potentially make sense on a sentiment basis. And if you wanted to be very sensitive to sentiment, then if price moved up to that R1 pivot point, you would consider taking profit there. And if price moved up to that resistance level there, it's another price you could potentially take profit, or you could at least move stops to break even ahead of the, at the close of today's session. So that's how you go about doing it. That's how you trade short-term sentiment biases. It's how you trade strength against weakness. Max says, I took this euro pounds long. Very good, Max. Well, that was, if you worked that out, well done you. Do you know what I mean? Kudos to you, Max, for that. A few smaller points, like if you're trading this strictly on sentiment, you wouldn't hold this probably before, like at the close of play, you just close out, because there is a potential for sentiment to change, right? So generally speaking, sentiment, like the way I've outlined here, Max, lasts like maybe 2 or 3 sessions, right? That's what you could sort of anticipate. That's what you could expect. So that's where we're at with the euro pound. Very good. Well done. I'm glad you worked that out. That's not a. So that's quite advanced. So well done, Max. Okay. So what I'm going to explain now is what we need to look at for that ISM data. That is very important. So first of all, I just want to run us through the big picture so we understand exactly what's going on, right? Now, if you take a look at the dollar, we can see that since the start of the year, let's just reset this chart. Since the start of the year, the dollar's been gaining. Why? Because inflation was surging and the Fed is expected to hike interest rates. So when a central bank hikes interest rates and expects to hike interest rates, that boosts demand for the currency. Think about it like this. If you are holding a currency, you want to hold a currency that has a high interest rate. So the dollar, as the Federal Reserve is hiking interest rates, you see the dollar demand. Now, the dollar demand was amplified by safe haven demand, particularly as there were fears over a global recession. So now we had the dollar being, ultra bid from around sort of April of this year on expectations of a global slowdown and on expectations that the dollar is being bid as a safe haven flow. Then we had this dollar, and from around this time, analysts were saying, well, we must have reached peak dollar now. We must have reached peak dollar now. And people will keep expecting peak dollar to be reached. Then we had sort of a pullback beginning in the dollar that was really confirmed with the FOMC meeting. Now, the FOMC meeting had the Fed basically go, we're now going to a meeting by meeting basis. In other words, they're saying, we're not automatically going to be hiking interest rates now. Just to bring inflation down. We've also got an eye on growth. So we've seen the dollar break down through this trend line, retest that trend line. We're at an absolute crossroads, and we've got this bullish engulfing bar forming from major support around that 105.50 region. Now, what that means is the dollar's trying to decide what to do. And if we see slowing growth, the expectations are that the Federal Reserve will be more tentative in hiking interest rates because they're sensitive to slowing growth. But will they? That's the question. Now, we had a couple of Fed speakers out yesterday that boosted the dollar higher, and that was Fed's Bullard and Mester. Fed's Bullard said they consider rates to be moving into more restrictive territory, and Fed's Mester said she expects no suggestion that inflation is actually leveling off. So that's what allowed the dollar to rise. But basically what we need to know is that the Fed's data dependent. So what that means for us is that data is going to be crucial to see where currencies and commodities and equities move next, because that's what the Fed's going to be going on, the data. So what data do we have? Well, that's the key question. Well, we have some crucial data around growth coming up today at 3 o'clock. Right. So if this growth data comes in below minimum expectations at 51, right? So if it comes in below 51, this is what we'd expect. I'll run through what we'd expect so you know. So first of all, we would expect 10-year yields to fall lower, right? Now, we'd expect 10-year yields to fall lower, and if 10-year yields fall lower, don't forget that will allow the yen to strengthen, and that will send the dollar lower. So if we get a big miss in the ISM data, the first currency pair we would expect to see falls in is the dollar yen. So let's just get this crystal clear. If it's below 51, we would expect the dollar yen to fall lower. Let me just call up the dollar yen and I'll show you what I'll be looking for. I'm going to be trading commodities. I might have a pop at the dollar yen if it's relevant. And your first target would be that 132 region, 33. Second target will be that 13140 region. Okay, that is easily reasonable if we get a miss of 51. But we want to see yields move lower. Remember how closely the dollar yen tracks yields? So you can see here, this is a 10-year yield chart on the dollar yen. So a drop in yields, so an immediate drop in the dollar yen. Also, we'd expect a drop in the New Zealand dollar Japanese yen. So this is on the basis that we have an ISM miss below 51, then we'd expect, if we just look at this. New Zealand employment data, see it came out a miss across the board. 70.8% for the participation rate, employment change below 0%, and New Zealand unemployment 3.3%. So below the low expected, all of that's negative. So that means there's a bias to sell the New Zealand dollar. So if we see a miss in yields, then a very nice trade, and you can see I've got this up ready to go, will be a New Zealand dollar yen short. First target 83, second target 82.50. All right, very simple. Now the other reaction we'd expect, and this is what's been driving gold and silver higher, is we'd expect that fall in sub 51, we expect a fall in the dollar and real yields. That's what's been pushing gold and silver higher, okay? So if you just take a look at gold and silver, you can see here, gold, silver, pushing up firmly from 1850, firmly from 1700. If we see a miss in the ISM print, expect more upside in gold and silver, okay? And you could trade from pivot point to pivot point in a very similar way to what we looked at there. Let's have a look. Here we go. We've got a gold chart here. And you could look at something like, you know, first target 1780, second target up to that 1786 region, and maybe even higher. Okay, so that makes sense for gold. For silver, we expect a move back up to that 2040, 2050 region would be a fair target there in silver. Potentially get a bit more if price keeps edging higher. All right, but that is only in the scenario where we get an ISM miss. If it's a beat, we'd expect yields to maybe push up a bit higher, maybe a bit of dollar yen upside, but that's not the opportunity that I really see. You could maybe look at trading equities lower, maybe NASDAQ, S&P 500 if we got a big beat above 55.9. You could maybe look at trading dollar yen ups. Dollar yen upside would be the go-to pair, because expect 10-year yields to move higher and expect dollar yen to move in sympathy. Yes, Max. Right. It will impact Aussie yen. As Max asked, will that impact Aussie yen as well? Like, this is what you need to know here, right? So look at this, Max, and get this straight. This is the basket of yen currency, right? And this is the 10-year yields. When the 10-year yield rises, the yen weakens, right? When the 10-year yield falls, the yen. When the 10-year yield rises, yen weakens. When the 10-year yield 10-year yields falls, the yen strengthens. Okay, so when we have upside in yields, that weakens the yen. So that recent upside we've seen in yields has just been weakening the yen. When we see downside in yields, so downside in yield, that strengthens the yen. Downside in yields strengthens the yen. Downside in yields strengthens the yen. And the other major driver of the yen is oil, right? Japan imports a lot of its oil. So when oil prices are high, that tends to weaken the yen. High oil, weaker yen. High oil, weaker yen. But yen is being driven by yields at the moment, Max. So literally, just look at the yield chart. And if you see the yield chart start to drop lower again, okay, you can expect, if you see, so I'm getting confused here. If you see the yield chart starting to drop lower, you expect the yen to strengthen. So rising yields, falling yen. Rising yields, falling yen. Falling yields, rising yen. Is that clear, Max? So if bond yields start to rise, the yen starts to fall. If bond yields fall again, then we would expect the yen to strengthen. Yeah, got it. All right. Well, there we go. And don't get with gold, silver. With that gold-silver ratio quite high still, that means silver's cheaper relative to gold. So you might get a better move out of silver than gold with this gold-silver ratio, so up by 90. You can see here, like with silver, when this ratio is high, it means silver is cheap relative to gold. So a high gold-silver price ratio often precedes a short spike higher in silver. High ratio, silver catches up. High ratio, expect silver to catch up. All right, folks. Good. Yeah, thanks, Max. That's it. Like in here, I offer my analysis like every day. So I also have my own service where I do this like every single day. But this is what I do with HYCM. I do something on Monday and Wednesday, and this is for free. So just keep coming, and I'll keep explaining everything that's going on. Like, makes sense, right? Okay, so Bank of England meeting tomorrow. So the thing to look here, and this is, I'm just going to have a look at. Oh, Max, you think about joining? Yeah, okay, that'd be really good. You know what I mean? And that'd be really good. Now, one thing to say is the Bank of England meeting tomorrow. So this is what to look for. It's not about the hike. We're expecting them to hike by 50 basis points. That's not so important. Now, if they only hike by 20, if they hike by 25 basis points and revise growth lower, then expect a lot of euro pound upside. If they hike by 50 basis points and bring a recession forward to 2022, expect euro pound upside. So anything more dovish than the market's expecting, euro pound could outperform. Okay, so look for that tomorrow. Oh, yeah, just yesterday. Amazing. Okay, that's enough for today, folks. we will be back on Monday for sure. And don't forget that we'll be looking at the week ahead market analysis for next Monday as well. Okay, and what I've shared with you today about the ISM data, use the same for the jobs data as well. If jobs are a big disappointment, expect dollar downside, dollar yen downside, upside in gold and silver if jobs are a big miss. Thank you, everyone. Been a pleasure to be here. Good work, Max, getting that euro pound upside. Very good. And I look forward to speaking to you soon. Take care now. Goodbye.